The United States tax code is often described as terribly confusing, and yet it is in the middle of the pack compared to global standards. Still, if you're an adult, you have to file an income tax return, so you want to get it right. Paying too much in taxes is not any different than getting too little return on your investments. Either way, it costs you money. Because taxes are intimidating and complex, people are always wondering if they did it right or left some money on the table, and it gnaws at them. Hi there, my name is Pat Zumwish, your YouTube CFP. If the tax-related questions I just talked about haunt you, then this video is for you. Though I'm not a current tax preparer, I'm a CPA by background and will point out the common mistakes people make in their returns. As an added bonus at the end, I'll also tell you when you should seek to have your tax return done by a professional. Okay, here are the top 5 mistakes people make when doing their taxes. Number 1, they miss claiming a dependent, generally a sibling or a parent. If you provide more than half the care of a person, you are entitled to claim them as a dependent on your tax return. Furthermore, there are tax credits allowed for certain dependents. If your mom or dad is living in your house, the cost of housing and food is likely higher than you think, and you might deserve this additional $13,000 deduction on your return. At least that's the deduction in 2024. Number 2, inaccurately claimed credits or deductions. Because Congress has recently passed out credits like Santa Claus passing out candy canes, many people miss getting credits that they are due. Examples would be EITC, Saver's Credit, Child and Dependent Care Credits, Solar Roof or Electric Car Subsidy Credits, etc., etc. Make sure you use some software program, TurboTax being the most popular, to run your calculations, as throughout the process it might trigger your memory. Credits are worth far more than deductions because credits offer you tax liability dollar-for-dollar offsets. Number 3, people often do the standard deduction for convenience, but if you have lemons, make lemonade. Should your past year have a lot of medical expenses, you should consider itemizing rather than taking the standard deduction. And once you itemize, don't forget to take deductions for charitable donations, which includes the mileage in getting to those charitable causes. The following year might not work to itemize, but always look at each year on a standalone basis. Number 4, even if you don't itemize, some deductions can still be taken. One of the more commonly overlooked deductions is the student loan interest deduction. Note that not everyone is eligible, but these little gems can help you save on taxes due, and many people miss them. Number 5, don't miss out on making a Roth contribution. Even if you're covered by a company's savings plan like a 401k. Roth contributions don't get you a tax deduction, but Roth accounts never have their gains taxed as other normal IRAs do, and the amount of money that will save you over time is substantial. Note, if your income is too high to do a Roth contribution directly, see if a backdoor Roth will work for you. Lastly, I said I'd give you 2 hints of when you really might need a tax professional. If you own your own business, even if it's a side hustle, consider getting a tax professional. My observation is that self-employed people miss thousands of dollars in qualifying deductions and often overpay on their taxes. Secondly, if you're a high-income individual, let's say a family earning more than $400,000 per year, then I think people leave opportunities on the table that a tax professional can help them see. At that level of income, your marginal rate of mistakes is 40%. So the opportunity cost really builds up quickly. That's it for this session, and I hope you found it useful. Until next time, thank you for letting me help you do wise things with your money.